All right, let's talk about aerospace. You know, the common story is all about the post-pandemic recovery, the production backlogs, but we're going to go deeper than that. We're going to peel back the layers to see where capital is really being made, and more importantly, where it's being systematically destroyed.
Okay, so let's just dive right in with a massive paradox. In 2024, the entire aerospace sector hit about $860 billion in revenue. Sounds pretty good, right? Well, look at this number. When you actually account for the cost of capital, the entire value chain posted a combined economic loss of $14 billion. I mean, how is that even possible?
Well, to get our heads around this, we've got to break down what's really a bifurcated ecosystem. We'll start with that paradox, then we'll expose what we're calling capital traps, uncover the aftermarket moat, check out the teardown opportunity, identify the data arbitrageurs, and then, we'll pull it all together into an investor's playbook.
So first up, let's look at where all that capital goes to die. And, maybe surprisingly, it's with the very companies that are building the planes themselves.
Yeah, we're talking about a capital trap. So what is that? It's a part of the market where enormous investments consistently, and I mean consistently, fail to generate returns that are higher than the cost of that capital. Now, the crucial thing to understand here is that for every single dollar a company invests to grow, it's actually destroying its own long-term economic value.
And the prime case study for this whole concept? It's Boeing. Their return on invested capital, their ROIC, is a really staggering negative 8.35%.
Just let that sink in for a second. This isn't just, a bad quarter or some temporary slump. The data here suggests this is a fundamental, a structural problem with the entire business model of these massive airframers. They are basically in a state of chronic value destruction.
Now, this paints an incredibly stark picture. Just look at the spread between the return and the cost of capital. Boeing's is a jaw-dropping negative 19%. Airbus, well, they're also negative. But then you look at GE Aerospace and Rolls-Royce, and they're actually creating value. So why is that? It's because a huge piece of their business, we're talking up to 75% for GE, is in high-margin services, not just selling the engine one time.
Okay, so if the manufacturers are losing money, who's actually winning? Well, that brings us to the aftermarket moat, a business model that runs on completely different and, frankly, far more profitable principles.
You've probably heard of this, right? It's the classic razor and blade strategy. You sell the initial product, the razor, so think an engine or some complex part, at a very low margin, maybe even at a loss. And why would you do that? Well, it's to lock in a decades-long, super high-margin revenue stream from all the proprietary replacement parts. Those are the blades. The real money isn't made on day one, it's made over the 25 to 30-year life of the aircraft.
And this right here, this is the razor. Once this incredibly complex piece of original equipment gets certified and put on a plane, it creates this powerful, non-discretionary demand for proprietary parts and services for literally decades to come. It's a brilliant setup.
And this creates something that the experts call the moat of immediacy. See, when an airline has an AOG, that's an aircraft on ground, it's losing tens of thousands of dollars every single hour. So at that moment, the price of a critical replacement part, it's almost irrelevant. Availability is absolutely everything. And this, of course, gives the suppliers of those parts immense pricing power.
And nobody has mastered this model better than a company like Transdigm. They focus almost exclusively on these niche, proprietary aftermarket parts where they own all the intellectual property. And by doing that, they achieve an industry-leading operating margin of 46.7%. Just think about that number. Compare it to the rest of the industry, and it's not even in the same league.
Now, this whole aftermarket dynamic, it leads us right to our next big opportunity, the end-of-life value chain. This is a super specialized segment for managing aging assets, and some people have started calling it the Copart of the skies.
It makes perfect sense, right? With all the massive production delays from Boeing and Airbus, airlines have no choice but to keep their older planes flying for longer. And that creates a massive supercycle in the aftermarket for maintenance. And it also creates a huge opportunity for the firms that lease, trade, and eventually tear down these older planes for their valuable parts.
Okay, so here's the crucial point to understand. This is not a scrap business. You can't just pull a turbine blade off a retired 737 and stick it on eBay. Every single component has a paper trail, a detailed history, and it absolutely needs to be certified. And this creates what the source material calls the regulatory moat of paperwork. You have lessors like AerCap managing these incredibly complex lease agreements. You've got traders who need deep market insight. And then the teardown firms have to navigate all these strict FAA and EASA certification rules. These are huge barriers to entry, and they protect the profits of the specialists who really know how to play this game.
All right, finally, let's look at the ultimate winners in this entire ecosystem. These are the asset-light companies. They don't build, they don't own, they don't even service the planes. They just control the data.
I mean, here it is. This is the clearest example of value transfer in the entire industry. On one side, you have the asset-heavy airlines. They bear all the risk, fuel, labor, capital, and for that, they earn a measly 4% average return on invested capital. Then on the other side, you have the asset-light orchestrators, the global distribution systems, or GDS providers, and they're earning a whopping 20% average ROIC.
So we're talking about companies like Amadeus and Sabre. They run the centralized reservation systems that connect all the airlines to all the travel agents. And this image perfectly illustrates their position. They get to capture a fee for every single ticket sold, and it doesn't matter one bit whether the airline actually makes a profit on that flight. They don't own a single plane, but they're protected by these powerful network effects and incredibly high switching costs.
So, what's the big takeaway from all this for strategic capital allocator? Where should you actually be looking to find durable, long-term value creation in the aerospace sector?
Well, the playbook is actually pretty clear. The durable, compounding returns are not in building the airframes or in operating the airlines. They're found in the high-margin blades, those proprietary aftermarket components. They're found in the asset-light, transaction-based data systems. And they're found with the sophisticated asset managers who specialize in leasing and teardowns. When you dig into it, this analysis really shows that the true engine of profit isn't always the one that's bolted to the wing. More often than not, it's hidden deep inside the value chain, in a proprietary part number, a line of code, or a really complex lease document. The key, as always, is just knowing where to look.